for joining today. Just wanted to give you a little bit of my perspective on what happened with the bank failures over the last week here, and so and how it's really going to affect the mortgage business, if at all. But there is going to be some impact, but time will only tell here. And so just wanted to kind of give you just a brief overview, and I'm gonna try and get through this in 20-25 minutes. And if you guys have any questions at the end, I'd be more than happy to try and answer them. So the first thing that I'm going to do, which is going to be a little on the boring side, is that I'm going to read just an excerpt of an article that was written in the Wall Street Journal, and it gives a good summary. So this is a lot of the work that I've done is kind of the research on my own, but this is from the Wall Street Journal here, and I'm going to go through. It's going to take just 2 pages, or 3 pages, and it's real quick here. So how it all started: mid-February, Silicon Valley Bank goes to Goldman Sachs with a problem, and basically they said, we need a lot of cash to kind of fix our situation that we're in. And soaring interest rates had taken a heavy toll on the bank. Deposits and the value of the bank's bond portfolio had fallen sharply. Moody's, who does all the ratings for companies, their public companies, was preparing for a downgrade. So they were up against a little bit of a time sensitivity issue here. The bank had to reset its finances to avoid a funding squeeze that would badly dent the profits. And the conversations with Goldman Sachs, held over a course of about 10 days, culminated on March 8th. And they announced a nearly $2 billion loss and a planned stock sale that was to raise cash that spooked investors. The shares tanked the next morning, and the startup and venture capital customers with big uninsured balances panicked. And these are balances that are in the, millions and millions and millions of dollars. So they panicked. They attempted to pull out $42 billion of the bank in the single day. And so what Goldman Sachs did, the plan for the bank had a huge flaw, and it was underestimated that the danger that a deluge of bad news could spark a crisis of confidence, a development that can quickly fell a bank. Goldman's gold-plated advice came at a steep possible cost, at the steepest possible cost, and Silicon Valley Bank collapsed at warp speed in the second largest bank failure in the United States history, setting off a transatlantic banking crisis that regulators are working to furiously contain. And as of tomorrow, or as of yesterday, sorry, they're still trying to figure this out. And so this was a good kind of just couple of paragraphs on how the bank went down. But let me go into, again, some of my kind of the way that I look at this, and give you a brief history of like the banks and how they work. So this is going to be like a really quick piece of this, but it'll set up what I'm trying to do a little bit later. So if you deposited you deposited $100,000 at a bank, the bank will hold 10% or around $10,000 for you for that, like your money. So they'll hold that $10,000. And what the bank does is they try to make money on the remaining $90,000 of the money that you deposited at the bank. Now, this is an example of everything, but the bank's going to pay you 0.5% on $100,000 or $500 per year in interest. They're going to take that $90,000 and they're going to try and invest that. And let's say, for example purposes, that they're going to try and make 2%. And on that 2% of the $90,000 that they're investing, they make $1,800 a year. So they net $1,300 for the whole year on your $90,000 investment. So now you just multiply that times, millions of people, and the bank, they're in business to make money. They're not a nonprofit. They're in it to make money. And so what they want to do is they're using your other people's money, yours, to go out and invest and make more money on the investment that you made in the bank. Okay, so let's go a little bit further here is that they take that $90,000 and they're going to invest it. They're going to lend it out to customers. They're going to give business loans, car loans, HELOCs, all sorts of stuff that they're going to lend out to you as an individual, so that you can go out and buy goods and services. And let's just take the car loan, for example, because I'm going to use it a little bit later, but they'll give you a car loan for a 5-year period of time, or 3 years, 4 years, 5 years, maybe even a little bit longer, but let's just say that it's 5 years, and they'll give it to you at 3%, right? And so that's, they're charging you that 3%, and you're going to pay that 3% for the next 5 years. Okay, so just keep that in mind as we go forward here in the presentation a little bit. But what they also do is they invest in treasuries, mortgage-backed securities, and I don't want to limit it to just that. They invest in other things as well. They invest in businesses, startups, whatever it is, they invest in a lot of stuff. The reason why I show treasuries and mortgage-backed securities is because I want you to understand and how it relates to Silicon Valley Bank and what happened to them as they went through this issue of and collapsing. Okay, so I'm going to go one step further so that we get into the kind of some of the details. So let's just say that an example of investing in those treasuries, they buy a 10-year treasury at 2% with that $90,000. Okay, so let's say they did that in January, February of last year. If the bank keeps that treasury, that 10-year treasury that they invested in, if they keep it for 10 years at 2%, and I'm simplifying this a little bit, but basically they take your $90,000, they earn 2% per year on it with the treasury that they invested in, and they'll get the $90,000 back at the end of that term. So that's how a bond works. And so you wait that whole 10 years and you'll get your money back, right? Now, if for some reason, well, let's go to kind of the hold to maturity. So this is with the Dodd-Frank rules from 2008, 9, 10, and what they put in place was under Dodd-Frank, they basically said that as a bank, you do not have to report a mark-to-market adjustment on a long-term investment. It's called hold to maturity. So what they mean by that is that if you keep that $90,000 in that investment, that treasury for 10 years, then you don't have to mark it to the current market, right? In Silicon Valley Bank's situation, if they had to sell that bond today, because interest rates have gone up, the Fed has increased the Fed funds rate, which is, and inflation has gone up. And so all of the treasuries now are 6%, they're 6.5%. So in order for somebody to make the same amount of money as the 2%, this $90,000 today is only worth like $58,000. So if they had to sell that bond today, they would have to sell it at a loss of $31,500. Okay, but if the bank was able to keep that treasury for the 10 years, they would make that full $90,000 plus the interest and get their money back, right? But today, if they had to liquidate it, they would have to liquidate it at a loss, because a 2% bond today, because of increased interest rates, is worth way less, maybe 65 cents on the dollar at this point in time, until the treasuries or the the yields start to come down a little bit. Okay, so that's one example there. Now, remember that car loan that they were charging, the bank was charging you as the customer to go out and get that car loan. They charge you 3% interest on it. Well, as the Fed keeps on raising the Fed funds rate, that affects what you will pay as a depositor, but they still have that 3% car loan on their books. And so what happens is the bank is going to have to go out in order for them to keep deposits with an increasing interest rate market, with the Fed funds rate going up. They have to offer higher rates for depositors. So if you go deposit your money now at a bank, you can actually get 4 to maybe even 5% now. And so instead of the bank, that $90,000 or the $100,000 that you put in the bank, instead of earning 0.5%, you're earning 4 or 5% on your money each year. Well, if the bank doesn't offer that to the creditors, or to the depositors, then they're going to take their money and move it to another bank. And so the money is going to go out of, they're going to come out of, let's say, Chase, and move it into Citibank, because Citibank will be offering higher returns on the deposits that you put in there. And so they have to keep on raising their rates. Well, that 3% car loan is now costing them money. So it shrinks the profits at the bank. Now, this is a minor issue compared to the bigger problem that Silicon Valley Bank had. The bigger problem was their investments in treasuries. So imagine that $90,000 that you invested in the bank, or the $90,000 that they invested in treasuries of your money, imagine that being $80 billion invested in 2% treasuries. And the current value of those $80 billion in treasuries is only $52 billion. Now, if you didn't have to sell those and you could hold them for the full term of 10 years, you would get your $80 billion back plus the 2%. Not a problem. But if you have to sell them, you're going to take that huge loss. So instead of it being $80 billion, you're going to have to sell that for $52 billion. So the bank, they don't want to do that. And by the way, the bank doesn't have to report this $52 billion loss on their balance sheet because of that hold to maturity rule that they put in place. And that hold to maturity rule was basically, hey, you're going to hold those for 10 years. You don't have to see that loss. So the banks don't have to show this on their balance sheets to any of the investors in the bank. And in this Silicon Valley Bank's case, they were a public company. So it's the stockholders that didn't see this until they did a little bit of digging. So how does the Fed kind of fall into this whole situation? As they dig deeper, in fact, Jim Cramer of Mad Money, I don't know if you know him, but he has a show that basically talks about stocks and so forth. And he was really actually pushing Silicon Valley Bank that the stock was going to go up. And so as he pushed that, investors started to look into that, and they looked into it. And these are the things that they found when they started to look into it. So it showed that they had the I have a typo there, $80 billion in treasuries, and they had the potential loss. The bank's stock starts to go down, and because the investors on Wall Street are looking at this bank, they're actually selling the stock short. So they're basically telling it that the value is going to go down. And so the customers start to get worried, and they start to pull their money out of the bank. But the bank doesn't have enough money to pay them back, because that 90% or that $90,000 that you invested is, they don't have enough money to pay all of your $100,000 back. So what does the bank do? They sell 21 billion of their $80 billion in treasuries at a loss of $2 billion. So they had to raise some cash so that they could give it to the depositors and they can get their money back. But that spooked even more and more people, and investors started to get scared, and they started to tell everybody to pull their money out. So there was a total of $42 billion that was tried to be pulled out of Silicon Valley Bank in one day. And you can think of this as a tight community up in Silicon Valley. And basically it was people texting back and forth with everybody else and basically saying, go to the bank, get your money out, go to the bank, get your money out. Well, at the end of the day, Silicon Valley Bank does not have any money, and the bank is insolvent and shuts down. And so that is kind of in a nutshell how that went down. Now, I do not think that Silvergate Bank, I'm sorry, I keep on saying Silvergate, Silicon Valley Bank was not set up for success, meaning I don't think they had the right people in place, but there's something else that we don't know as well, because there was something else going on that is still not known to everybody, but we will find out over time. But basically they had no risk management officer for 8 months of 2022. In January, they hired a risk manager. And the reason I say that is that risk management officer would be in charge of basically saying, look, we have a huge issue here and we need to try and fix it. But the people at the bank, so especially the CEO, who is a board member of the San Francisco Fed, Gregory Becker, he should have known what the issue was. In fact, he did know what the issue was. And not only did he know, he sold stock while they were aware of this huge balance sheet issue that was going on. And obviously they went to Goldman Sachs to try and fix the problem. So he knew that it was a problem, but he sold stock. One of the other people at the bank was the chief administrative officer. Now, probably most of you remember Lehman Brothers. That was another huge bank failure back about 15 years ago. And he was the CFO for Lehman Brothers. So this chief administrative officer, he's got two bank failures, two of the largest bank failures on his resume. So he's going to have a hard time getting a job going forward here. But basically, the balance sheet showed a positive $12 billion at Silicon Valley Bank. And because of that hold to maturity rule, they did not have to show that $15 billion loss that they were taking in the treasuries. They didn't have to mark to market those treasuries, meaning that value, that $15 billion loss, they did not have to show to any of the investors. But if they did, they would have showed a negative $3 billion market share. And so, and they would have been insolvent. And that's what, when Jim Cramer was telling everybody to buy the stock because it was a good stock to buy, as they dug deeper into the financials, these are the things that they found. And then it was a landslide of kind of like, here we go. Now, the Fed steps in, the government steps in, the Treasury steps in. And if you were a depositor at Silicon Valley Bank, and let's say that you had $1 million in the bank, technically you would only get $250,000 back of your $1 million. So that is what the nervousness and the scare is for everybody at the bank. And this bank, because it was in Silicon Valley, the average balances were super high. And so there was companies in there that had $50 million in there or more. And that all of that money was at risk, and they would only get $250,000. But the Fed and the FDIC steps in and they guarantee 100% of the deposits. The bank closed down. And what they used, the Fed or the government, what they used is a thing called the Bank Term Funding Program. And that Bank Term Funding Program is money that is set aside in the Treasury for issues like this. And the reason why they did that was they actually used that money to buy those treasuries that were worth 65 cents on the dollar today. They're basically buying them at full value at 100%. Okay, so they have the ability to hold those bonds or treasuries for the full 10 years. And so what they will do is they'll put it on the government's books, and they'll hold them there for 10 years until they mature. When they mature, they'll get their money back. So it's going to take another 9 years or so for those to mature. But this is how they actually bailed out the customers at the bank. They didn't really bail out the bank because Silicon Valley Bank is now shut down, and there's nobody there, right? So the fear was, and the reason why the Fed actually stepped in here was that it's going to happen to more and more banks. And I don't have a slide for this, but yesterday, 11 banks got together and bailed out First Republic Bank. And so they basically, those 11 banks took $31 billion and infused it into First Republic Bank. And again, it's trying to basically say, look, your money is okay. This is the banking system is fine. You don't have to have any worries about it. So that's what they're trying to do, is they're trying to instill some confidence in everybody and keep them from moving their money around to different banks or scared that they're going to lose their money. So again, this is kind of the whole process. Now, what does this mean for mortgage rates, for lending? Well, it's a flight to safety. So when I say flight to safety, that means that as an investor, the stock market is actually, there's losses, right? So when the stock market starts to tank, most of the investors take their money out of the stock market and put it into treasuries. And when they put it into treasuries, the bond prices improve. So they go up, actually, the bond prices, and the yields drop. And when I say the yields drop, they've gone from around just under 4% this week to 3.4. I haven't checked recently, but they're right around 3.4, 3.5%. So they've gone down 0.5% in the yield. When that happens, mortgage rates drop as well. And so we haven't quite seen the full impact of that drop yet, but it is, that does happen, and mortgage rates will continue to go down. The Fed has to rethink raising rates further. So they have a meeting coming up next week. And next week, the fear is, well, there's two sides. And basically one is, hey, with this whole banking thing, we need to calm down here and not do anything and don't raise the rates any further just yet. And then there's others that think that the Fed is just going to go ahead and raise another 0.25%, the Fed funds rate, to make sure that they slow down the economy. I have opinions on all of that, and I'm not going to really express all of them, but there is, the Fed has to, they basically broke the system with the banks by raising the rates too high. So it's super important that this is a very touchy issue and a sensitive issue at this point in time. And next week, they really have to take the time to think through if they're going to put another 0.25% increase out there. And in fact, Europe just increased their version of the Fed funds rate 0.5% this week. So they just kept on going and increased. The importance of the yield curve. So what the Fed does has huge impacts, and I'm not going to go through an inverted yield curve and what happens, but Basically, it is shorter term rates are higher than longer term rates. So a 6-month treasury is paying a higher return than a 10-year treasury. And that has to switch. You have to get the yield curve back. And the only way to do that is to have really deflation or no inflation and bring that inflation down. And they're trying to get it down to 2%. It's really sticky and they're really trying to get it down there, but it is, that's the deflation has to happen. So things have to go down in value in order to get that deflation, to get the inflation down to the 2% level. And then just there's volatility in the market. So mortgage rates, they're like stocks, they change every single day. There's a huge volatility in the market on a day-to-day basis. In fact, I'll show you on this next slide. This only shows Monday or Tuesday. And this is a 78 basis points is a huge move in the pricing of bonds, okay? And I'll show you in just a second. The yield on the 10-year treasury, again, this was when it went down to 3.54, but 14 basis points movement in the yield that's a big movement. So you can see these lines here are daily kind of changes in prices, okay? And you can see that the last 3 days on this particular chart were like very long lines. That means that there was a low and a high, and it was just a lot of movement back and forth. And you can refer back to even the previous days here, and you can see how short those lines are. So it is very volatile right now, but we are starting to see the improvement of those mortgage rates. So banks are going to have to watch their balance sheets. They're going to have to like hang tight. They don't want to lend out more money. They're going to get more conservative. They're probably going to have to raise capital, like First Republic Bank had to get more capital into their bank. They're going to tighten their lending standards. So basically, in order for you to get a loan, they're going to tighten those lending standards, and they're going to make it more and more difficult for you to get a loan. And so less loans are going to be given. If you have less loans, that's going to slow down the economy, and that's not a good thing. We want these banks, we want them out there, we want them to be lending money to you as the customer, because that creates more activity in the market and stimulates the economy. So what now? What's happened? So I want to show you this chart. It's a little bit on the small side, but basically, I want you to not fear about the real estate market. Since 1941, the real estate market has gone, and this is a little off because there's a couple of changes in here that I saw that need to be changed, but it's gone 73, 7, and 1. 73 wins, 7 losses, and a few ties in there. So there's a few ties, but basically what I'm telling you is that every 73 times since 1941, the real estate values have gone up. So you can see in this chart all the green, and then in 1991 there was just a slight decline, and then back in 2007 to 2011, that's when we had our housing crisis basically, and values dropped because we had so much inventory, and there was just not enough people to buy houses at that point in time, just because of the economic situation that we were in. But you can see all the rest of it is still green. And I'm telling you that real estate is a good investment to be in over a long period of time. And so I don't think, with the circumstances that we're in right now, especially with the banking collapse, I still think that there's a limited inventory and values are still going to stay strong during this time, and we're not going to have really any other issues. So the Fed, they need to stop their reckless policy on raising interest rates and figure out what else to do because the economy is going into a recession. But the good thing is, and the last thing that I will leave you with, is that the mortgage rates will continue to drop, and the rates will improve, and that will actually keep the housing market stays strong during recessions. And so during this recession, you will see that the mortgage rates go down and values stay strong. So with that, I will, that's all I have for today. But if somebody wants to ask any questions, I'd be more than happy to answer any questions that you might have. I see, let's see here. There's somebody was in the chat. Let me see here if I can do this. So the FHA new equity standards banning is not the situation. No, it is not the situation there. No. Does this make you skeptical of other banks? So it doesn't make me skeptical, but it does. There are going to be other banks that do have issues, and they will come out of this because there is going to be a spotlight on some of these other banks in the system. So you will start to see over the next 2 weeks to 30 days, there'll probably be at least one more shoe to drop in this situation. My opinion of online banks. I don't, it's the same as every other bank. You do your research and make sure that they are in a good position. A lot of people right now are moving their money to the bigger banks. So they're moving them to Chase, Wells, Citi, etc. So they're moving them to these bigger banks because that's where they feel like the safety is. So I would say do your due diligence on that before you start moving into that. So make sure you do your research. Awesome. Thank you guys for taking the time to listen to this webinar. If you want to reach out to me via email, you can, or text. Just send me a note and I'll get back to you as soon as possible. This is Mike Wise with Mortgage Wise at Capstone Direct Mortgage. Have a good day.